Welcome, Rick. I don't know if you are able to turn your camera on, but we are going to get started. We thank John for being here today. He reached out and shared some information with me about some differences that he's seeing in school district finances around arbitrage and wanted to talk about it with us. So we are excited to welcome him here today. Is that Jeff Bertrand on too? I think I saw him register. So welcome, Jeff. Deb is joining us by phone today, and I'll turn it over to John to share the topic with us.
Thanks, Lori. Good morning, everybody. Thanks for joining in and diving into this complicated topic of arbitrage with me. It's my second favorite French word after defeasance. I am John Major. I'm the registered municipal advisor principal at American Deposit Management. We're based in Pewaukee, Wisconsin, which is just outside of Milwaukee. And I've been with the firm now for 9 years and in finance and investment for 10 or 12. So this is an area that we did not work on for a long time at the beginning of my career and has jumped to the forefront in the last few years. And so if you are experienced with that, you'll hopefully gain something. And if you're not, then hopefully this will prepare you for what you might potentially be looking at. So I will share my screen here. So our main question today, do you need to worry about arbitrage? And the answer is, of course, it depends. If you have borrowed money recently or plan to borrow, there are really 5 pieces to this puzzle that we're going to talk about today. Arbitrage is really based around what your borrowing rates are versus what your investment rates are. So we'll discuss where the market is right now and where it's been. And arbitrage rebate is sort of the all-encompassing term that people use, but there are actually 2 rules here. So there's arbitrage rebate, and then of course this is the IRS that we're dealing with. So there are exceptions to every rule, and then yield restriction is the secondary or backup rule, which is really time sensitive. So we will discuss the differences there. So borrowing rates, this is the 20-year history from the end of last year for long-term, high-quality, AAA rated, 20-year maturity, tax-exempt bonds. So very similar to what you might issue if you had a big capital project coming up. And you can see there was about 15 years of a downward trend, what we call in the business ultra low interest rates for a lot of that time, where rates were essentially zero for short-term, like bank rates. And borrowing rates were very low too, but you can see after COVID, we've bounced up significantly. And so even though rates may feel high, we're actually very close to the 20-year average, and that's very close to the even longer term average. So kind of a normal situation as far as borrowing rates are concerned now. And these have come down just a little bit with the recent Federal Reserve decrease, but very similar. So investment rates, when you are looking, especially in school districts, especially for the generally short-term cash that you're looking at, even on a building project only a couple years long in most cases, the Fed is going to drive most of the changes in those rates. This is a chart of the federal funds effective rate. So that's the rate that the Fed sets and then is used by banks to borrow reserves to and from each other overnight. So it's like the baseline of what it costs banks to get money, and then that flows through to all the other services that they offer. again, you can see the long-term trend of low rates, decreasing rates. But going back to the 80s, we were at 18+%. I wasn't alive, but I've heard stories. And now we've come back to, with this very large increase in the last few years, come back to a more normal level. We're still in the 3.5% to 4% range on Fed funds, and maybe decreasing a little bit here in the near future, but not ultra low as we've been dealing with for the last several years. This is not the same chart. This is the 3-month Treasury bill. So this is essentially the risk-free rate that you can deposit money with the government, have it be fully protected and backed by the full faith and credit of the United States government, but still earn some money. You're borrowing money to the government for 3 months, and then you get your money back. So again, very similar trends and normalization of rates there post-COVID. Now, that's borrowing and investment rates. Now your options, which you may or may not be super familiar with, but we have our first mantra is failing to plan is planning to fail. So number one step, if you are looking at investments, even if it's just for general funds, is to double check your investment policy. The state statutes don't allow you to do anything too crazy. You can't buy Bitcoin or Tesla stock or anything like that, but you do have options. And so we always feel that the state statutes are the baseline, and there's not really a reason to make your policy more restrictive unless you have a particular issue or concern with a particular type of investment, or your board or other constituents do. So that's really number one. And then that is based on your risk tolerance. You have multiple options here, the LGIP, securities, bank products, and all of these options are very safe, but there's still an element of risk to each. So you want not just your policy to be in place, but then a plan based on your specific needs. So it's one thing to have a policy, it's a completely different thing to implement that in the way that's going to be most effective for you and your district. So your options here, again, very safe and secure, borrowing your money to the US government and its agencies, bank products, which you're probably very familiar with, commercial paper, which is short-term unsecured debt from major corporations, tends to be very safe, but is not backed by anybody or anything. It's just that you're betting that Coca-Cola is not going to go bankrupt in the next 90 days because they're so big and been around for so long. And then the last one that I have highlighted here is SLUGS, which stands for what's the first S? Local government series and municipal bonds, taxable or tax-exempt securities issued by a government subdivision. So these are potentially exempt from arbitrage, so that when we're going to talk about that later and why that might be useful. But all of the values here, except for bank products, are going to fluctuate based on the market. So you are required to mark them to market in your financials, meaning if the value goes down, you have to show that even if you haven't sold the security for a loss. And that's something that I think superintendents and board members don't always understand. When you see a lot of red on a statement, which has happened a lot lately, it's really not a loss unless you have to sell it at the time that the value's down. All of these investments will mature, and assuming that the government continues to pay its debts and the corporation that you've invested in doesn't go bankrupt, you will get all of your money back at maturity, even if you've shown a unrealized loss along the way. So that's very key in managing your expectations, both when you're looking at a statement and also for what you're going to invest and how much you're going to invest. You always want to have liquidity available so that you don't need to sell any investments early, so that you don't have one of these events that would cause you to actually realize a loss like that. So where are, oh, it's a state and local government series. It finally came to me, slugs. This is from last month, but this is from just after the Federal Reserve lowered their target rate. So rates really haven't moved that much in the last 3 weeks. And you can see the blue line is a year ago. We were significantly inverted on this yield curve. So you actually got paid less money to tie up dollars for at that 10-year red line versus if you were to lock up money for 2 years, which is not the norm. The green is a month ago, and that's more of a normal slope on the curve where from 2 years to 10 years, you're getting a premium for borrowing that money for that much longer. And then the gray is right after the Fed cut. So we had essentially the same steepening curve. And where this comes into play is really the strategy around how you take cash that you have and invest it for the future liabilities that you might have. And in arbitrage, we're talking about bond proceeds, so typically a capital project, but it applies to any longer term funds that you might have for facilities maintenance or any other situation where money is going to sit and be allocated for an expenditure in the future. What are rates doing right now, and what will they be in the future? You can see on this chart that gray line is about 4% you're earning on a 3-month treasury bill. So if you borrow the money to the government for 3 months, you're going to get 4%. If you go to 2 years, now you're down to close to 3.5%. So if you take a haircut of 50 basis points or 0.5% to lock in your money for 2 years, that's really the market telling us that they think your average return over the next 2 years in liquid cash or equivalents is going to be about 3.5%, which means that rates overall are expected to go even lower than that. So the market expects your average return over 2 years to be about 3.5%. Actual rates are expected to go farther or about 1% lower over the course of that time. So if you were just in cash and the rates went slowly down over the next 2 years to 3% from 4%, your average return is approximately 3.5. That would be the baseline for your 2-year rate. So if you think that rates are going to go down more than that, you definitely want to lock in money, and you're essentially playing defense there. If you don't think rates are going to go down that far, then you would want to stay either shorter term or liquid and earn the higher rate now, as opposed to playing defense against rates going down. So that's really across the board. Any term that you're looking at, that's how you would determine where the market thinks rates are going to be. What are you earning now in cash and equivalents? What are you going to earn for that term? And then you can infer what the market thinks rates are doing overall. And speaking of that, this is the FedWatch tool from the CME group, which is probabilities based on the futures markets. You can see 97.8% that there's going to be another cut in at the end of this month. They also think there's a very high percentage chance that we will get another cut in December. These are quarter point cuts, 25 basis points. So that would put us right at about 3.5% by the end of the year. And then next year gets a little foggy. The market is not as certain what's going to happen. which of course the longer time frame typically is how that works out. But that's really what we're expecting, is rates to continue to go down, maybe not drastically, but considering the market, the economy overall, the labor market softening, and the other factors that the Fed is looking at, they think that we will need to lower rates in order to keep the economy plugging along. So do you need to worry? Of course, it depends. Let's talk about what arbitrage is. It is the nearly simultaneous purchase and sale of investments in different markets in order to profit from price discrepancies. So your tax-exempt status in the district provides you the ability to sell or borrow at lower yields because your investors that purchase your bonds don't pay taxes on the interest that they earn, but you can buy at a higher rate, invest at a higher rate, and you don't pay taxes on those taxable investment earnings. So that is the difference. You instantly have that profit because of your tax exempt status. And if you go above and beyond what is allowed, your liability is generated, and that's in aggregate for the entirety of your proceeds being outstanding. And that difference, what your bonds earn versus what they cost, or the arbitrage, is rebated back to the IRS. So that's how that gets its name. The calculation is due at least every 5 years while proceeds are outstanding. We would, of course, advise you to keep tabs on it much more regularly. Usually every year is okay, but in the last couple of years, we've been doing even quarterly reviews with clients because the market rates have just been changing so much that we want to keep tabs on where everything is and make sure that our clients are aware of what their potential liability is, and that affects how much money they can spend on their project. And the rubber really meets the road here. If you fail to comply, the penalties are financial, can also lead to losing your tax-exempt status on the issue, which I can promise you would be in the newspaper, and nobody wants to have that happen. So we really want to be on top of these. So why does arbitrage exist? To prevent abuses of tax-exempt status for bond issuers, as I've said. Without it, there would be that profit incentive to maintain debt that may not be absolutely necessary. If you have a budget deficit or something along those lines, you might have incentive to use additional earnings to help with that. So the rule of thumb is borrow what you need when you need it for an appropriate duration. And as I said at the beginning, there are arbitrage rules, and then there are yield restriction rules, and they have overlapping requirements in these IRS sections. These rules apply to every tax-exempt borrowing. General obligation and notes are the most common, but there are these do apply to all the others, and all the different funds as well. So project funds, escrow funds, debt service, and transferred proceeds. So if you were to do a bond anticipation note and then refund that with a general obligation bond, there are requirements for both of those. So compliance is due on arbitrage at least every 5 years. We talked about that. But if rates are moving, that's really where you want to be reviewing more often, up or down, because that's where the opportunity would be to potentially change your investment strategy. Yield restriction applies after what we call the temporary period. So that's typically 3 years, but it can be 5 years. It's really based on the expected expenditure of the funds. So if you have a massive project that you plan on taking 4 or 5 years to complete, you may get a 5-year temporary period. Otherwise, it's expected that building a new building isn't going to take significantly longer than 3 years. So arbitrage applies for that. And then yield restriction is a separate calculation that happens after that temporary period applies, and it supersedes some of the exceptions as well. So that's another key point. Another point here that's important, 85% of your proceeds need to be spent to avoid arbitrage bond designation, need to be spent on construction. So that is another area where if you are labeled an arbitrage bond, you lose tax exemption, and that can be a real problem. So the exceptions, small issuer is a big one. The limit is 5 million for everybody except K-12 schools. You all get 15 million per year for public school construction. So you're able to borrow 15 million and be completely exempt from arbitrage. You could earn 10 times what your bonds cost you and keep all of it. But that only applies for that temporary period of 3 or 5 years. And then you are restricted on yield based on your bond yield, which has happened a lot in the last few years. We had clients that were exempt, they collected their money, the project was delayed or for whatever reason took longer than expected, COVID and all the rest, and they ended up having money for longer, and their yield on their bonds was very low, and then by the end of their temporary period, rates were very high, and now you have this separate calculation, which I will show an example of in just a minute. The other ones are spending exceptions. So if you spend your money fast enough, basically, they will allow you to keep all of your interest earnings, whether or not it's more than your bonds cost you or not. 6 months, if you spend all your money within 6 months, they don't consider there to be an arbitrage opportunity that they want you to pay back. 18 months and 2 years, you have to hit all of these hurdle rates in order for you to get the exception. It's not just 100% within 18 months. There is a reasonable retainage of 5% on both of those for up to 30 and 36 months respectively. So there is some wiggle room at the end, but you have to hit the other hurdles along the way. And these are cumulative, so it includes interest earnings, which is definitely something in the last few years where we were getting 4 or 5% on bond proceeds. So yield restrictions. Restricts your investment earnings above your bond yield. It's per issue, so it's not the project, it's by issue. If you borrowed money today, you have 3 years. If you borrow money next year, you have 3 years from next year, even if it's all the same project. After your temporary period, the arbitrage calculation continues and the yield restriction calculation is concurrent, and you pay whichever one is larger, essentially. So if no arbitrage rebate is due, you may still need to apply a payment for yield restriction. And those are due 60 days after the computation date. So that's computation date is either once the money is spent or every 5 years if your proceeds are still outstanding. This is a visual representation of what we saw in the last few years. Client borrowed money at just over 2%. They were investing money at almost zero for a long time, and then rates shot up while they still had proceeds outstanding. So there was no liability to start, but that doesn't offset a liability going forward after the temporary period. And this is sort of ingenious by the IRS, hate to say it like that, but it doesn't allow you to just hold proceeds long enough that rates are favorable and you can just profit off of holding proceeds outstanding. Again, they don't want there to be an incentive for you to have debt outstanding that you don't need. So you can't hold money and earn more as the market changes and then just leave it that way and have it be like an annuity. And this is that cumulative calculation that I talked about. So through 5 years, the arbitrage rebate is zero, because they earned so little at the beginning that it wasn't offset by the higher earnings at the end. But because of the temporary period and the yield restriction calculation, after that 3 years, they were above their bond yield and did have to pay yield restriction payment. So some case studies to put this all into context. I have 3 stories. 2 are good, 1 is not so good. This first one here is the worst case scenario. The client that we ended up working with, they chose not to engage anybody, including us, for arbitrage rebate at the outset of their project. Rates were low, they didn't think they needed to, and then rates shot up. Once it was clear that they did need to worry about it, there was just delays in the process. So this whole thing is 5 emails, but it takes time. People have other things going on. It's not always just an immediately available piece of information that can get sent right back. The client delayed the contract that was sent to them, even though they knew they had to get it back. The provider also was delayed. Bond counsel was delayed. This was right in the middle of the next election cycle, so they were busy doing other work as well. And then that eventually led to the calculation, which was late, and turned out that the client ended up with a penalty interest of over $6,000 on their, I think it was about $100,000 payment, but it had been a month or 2 delayed to get that to the IRS. So it can be real money, and days can just fall away. Everybody's busy, everybody's got 1,000 things going on, and if you have that happen a couple times in the process, you can end up owing real money on top of the actual rebate. However, if you're paying attention and you're on top of it, then we have situations like this. So this is a client that we worked with from the start. They ended up with about $1 million in investment earnings over the course of their project. They finished the scope. They had no other projects that they wanted to spend the money on. And importantly, they had maxed out their arbitrage earnings. What they wanted to do was continue to hold those funds for an additional 2 years to reduce their debt service levy in the future. But they were going to be stuck paying essentially all of their interest earnings back to the IRS if they did that. So what we did was actually shift their investments to tax-exempt securities, state and local government series, demand deposit account to be specific. They took a haircut on the rate. Rates were paying, CDs and other investments were in the 4+% range, and we put them in at 3.5%, but fully exempt from arbitrage. So they were able to collect tens of thousands of dollars in extra interest over the course of a couple of years that was not subject to arbitrage and could go right back into their levy and cost them nothing, essentially. As a little bit of paperwork to change the investments, but otherwise, they just needed to shift their strategy and be able to pocket the difference. And that's because they borrowed at such a low rate, and then the interest rates in the market were that much higher once they got to this point. So it's the timing that's important. If you borrow, now or in 2026, after we get another decrease of 100 basis points, and then 2 years, 3 years from now, your project's not done, or you have a situation like this, it's very possible that rates could be higher and you could be in a position just like this. And this is another one that we're actually still working on. Very similar situation. Money was borrowed at a very low rate, around 3%. we were delayed about 12 months in not just the start of the construction, but actually the planning as well. So we didn't have a draw schedule. We didn't know when the money was going to be spent for about 12 months. We did some very basic investing, some 12-month, 18-month, 24-month terms, but most of the money we kept liquid. And then over the course of that 12 months, rates really shot up. And so the client was going to end up earning well above their arbitrage limit. And we ended up doing the same thing. Because rates had gone so high, we could shift to tax exempt rates that would normally be lower and wouldn't make sense to invest in since you all don't pay taxes. But because of that differential above and beyond what their bond yields were, and that they had already maxed out their investment earnings as far as arbitrage is concerned, it made all the sense in the world to shift, take a lower rate, but then have all of that earnings coming up be exempt from arbitrage. And so this particular client is about a $30 million project. They are going to earn about 2.7 million total. And that includes this flip, which it would have cost them about 500,000 in a liability back to the IRS, and they're going to end up with about 250, 300,000 that they can keep. So it's $750,000 swing by changing this strategy at the right time. We took all of the investment earnings we possibly could. We did the projections into the future because we knew they still had, at the time, almost 2 full years left in the project. And so we can project out. It's a time value of money calculation. It's, it's not exact when you don't know exactly when every penny is going to go, but you can get a good idea. And so we were able to back into what the net result would be. And then if we take that money out and have it be exempt, what that would be. So it's a huge swing and a real benefit to the district. And again, didn't cost them anything. However, the process to make that happen with this particular district took 5 or 6 months longer than it needed to. And so it should have been about $1 million swing, but they had a old investment policy that didn't allow them to purchase securities at all. It was bank products only. So we had to go back and forth with their corporate counsel. We had multiple meetings with their board and to explain the situation and get everybody comfortable with what we were doing, that we weren't buying Tesla or Bitcoin or anything like that, it's still super safe. It's still within the guidelines of the statutes, but it was just that process of going back and forth. And it cost them, $250,000 in interest by not having that prepared in advance. So there's 2 lessons there. It's, prepare in advance and understand where you're at if you're getting a large amount of dollars in that you're going to have to manage. And then also, what to do and the timing of it as the market changes potentially in your or during your project. So the last bits here, just best practices, support for designated officials, training or other conversations with your providers and partners, good record keeping, communicate with your vendors, especially for major changes like a refunding or defeasance, and keep your records for at least 3 to 6 years after your bonds are paid in full. So this is something that can definitely outlive your tenure, and being organized, having everything in an accessible place for your potential successor is, we run into it all the time where folks just don't know where things are or don't know why decisions were made the way they were from 10 years ago. So that's another thing, is just record keeping and being able to access this information. If the chance you get audited is very low, but if you get audited or there's just somebody new that wants to understand, how are you going to explain it to them? So that's all I have on arbitrage. I see some questions in the chat.
And we've really just been having a conversation in the chat, John. um, and I saw Darren on here a little bit ago, but he must have had to hop off. Jeff, any questions from your perspective around what you're seeing, particularly from newer superintendents or business managers?
No, but like I put in the chat there, Lori, with the ability to bond more with LTFM now in districts, and they're jumping on that for roof projects and everything else. If
Mhm.
they don't watch, they'll dot their I's and cross their T's, they're going to get
Mhm.
in trouble, as John mentioned. But we've had such a change the last 5 years in superintendents and business managers. And
Yes.
like I put in my message here, if you don't have a good financial advisor who's overseeing this for you, you're going to
Mhm.
fall into a trap. But you still can't just trust that. You have to connect with them and see if everything's being done properly.
Yep. Yep. Well, you will have the recording of this session, Jeff, and please feel free to share it with folks that you work with if it's helpful. I think the goal from everybody is to be helpful for our new leaders and business managers. So, and let us know if there's a need for more conversation, either within the region with a small group or whatever, because I'm sure we can work with John or somebody else to coordinate that.
Yeah.
I do know that in our region, Lori, I can't remember if it's January or February, part of the PD session. One of them is on bonding projects planning. So I'm going to make sure we bring this part up as part of the bonding project planning conversation.
Good, good.
Yeah, that's a great point. Thanks for that, Jeff. I think in the end, all of this is still the responsibility of whoever is signing those bond documents. So as much as we're here to help, and our clients entrust us with that, it's still your responsibility to understand at least the basics and to know that it's a box you need to check and you need to talk about on some kind of regular basis as a part of your process, so that it may be something that you just say, nope, it's still nothing to worry about. But if you don't ask the question and you don't get the answer and then there's a problem, now you're really up a creek without a paddle. So,
And I do
and
think
that's why
that's
I'm talking about it, because we've had it in the last couple of years. We've had people that literally just thought, oh, we don't ever need to really worry about it. It's somebody else that has that problem, and it's not always the case.
yeah. All right. Well, thanks so much, John, for the information. And will you share your slide deck with us too, or is it linked in?
Oh, uh,
Um,
uh, I can email it to you. No problem.
okay,
I didn't do
perfect.
that yet. So,
Yep.
yep,
Then
definitely
Dave can
will.
share that out with the folks who registered. So,
Great.
all right. Thanks so much.
Thanks,
Thanks for being
everyone.
here, Jeff.